Okay, let's talk about taxes in Canada. For a lot of us, tax time can feel pretty intense, and the thought of dealing with the Canada Revenue Agency, the CRA, can be a little intimidating. But what if it didn't have to be? In this explainer, we're going to break down how you can manage the whole thing with confidence and, hopefully, make it all a lot less mysterious.
So here's our game plan. We're going to start with a simple pre-filing checklist. Then we'll take a peek behind the curtain to see what the CRA is actually doing. We'll talk about exactly what to do if you get one of those letters, what the huge difference is between an honest mistake and, well, not so honest one, and then we'll wrap it all up with the key takeaways.
This is the big question, isn't it? That moment right before you hit submit, you're thinking, does this all look okay? Getting some peace of mind right then and there is everything. And the good news is there's absolutely a way to check. And that brings us right to our first section, the pre-filing self-check. We're talking about 5 strategic things you can look at to catch any obvious issues and just feel way more confident about what you're sending in. Being proactive here is so much better than being reactive later. And listen, you don't need to be a tax whiz to do this stuff. First, just look at your effective tax rate. Is it kind of in the same ballpark as last year? Second, check the difference between your total income and your taxable income. If that gap is really small, maybe you missed a deduction. Third, do your credits actually match your life? Your spouse, any kids, medical stuff? Fourth, just do a quick logic check. Did the numbers from all those extra schedules actually carry over to the main T1 form correctly? And last, step 5, did anything big happen this year? Like you sold a house or your self-employment income changed a lot? Just make sure you're ready with the paperwork. Seriously, this quick review can give you so much peace of mind.
Okay, so you've done your checks, you filed your return, you hit submit. What happens now? What's going on over at the CRA? Let's pull back the curtain and see how their review process actually works.
Well, the first thing to know is that a real person doesn't immediately read every single tax return. Nope. Instead, the CRA uses this really powerful automated system called the risk scoring system. It's all about data. It takes your return and compares it against everything: regional averages, what's normal for your industry, your own past returns, and all that info from your employer and bank. It's basically just looking for anything that seems off.
So what kind of stuff gets flagged? Well, the big ones are pretty logical. Things like income that doesn't match the T-slips from your job, or deductions that seem way higher than average. The system also looks for weird imbalances, like a business that just seems to lose money year after year after year. Oh, and a huge one is forgetting to report foreign assets. Knowing what they're looking for can really help you spot potential issues yourself.
And this is maybe the biggest misconception out there. The refund hits your bank account. The money is there. You're all clear. You're in the green, right?
Well, not so fast, and this is a really crucial point. In Canada, we have a self-assessment system. That means they often process the refund first and ask questions later. So getting your money back does not mean your file is closed for good. The CRA can, and often does, come back and ask for supporting documents down the road. Which leads us right here. One day, that official-looking envelope shows up. It's a letter from the CRA. Okay, first rule, don't panic. There's a clear, totally manageable plan for how to handle this effectively. Here's your playbook in 3 simple steps. First, don't just skim it. Read the letter. What do they want exactly? Which specific items are they asking about, and what's the deadline? Second, draft a really simple, polite cover letter that addresses their questions point by point and says, here are the documents you asked for. And third, just gather it all up. Get those receipts, bank statements, whatever it is, and get them organized. A clear, organized, and on-time response is your absolute best friend here.
If you remember just one thing from this section, make it this. Do not ignore a letter from the CRA. Being proactive, even if you're just calling to ask for a bit more time, is always, and I mean always, better than radio silence. Because if you don't respond, the CRA is just going to make its own assumptions. They'll assume you can't back up your claims, and they'll reassess your return using their information. And trust me, that almost always means you'll owe more tax, plus interest, and maybe even penalties.
So what happens if there is an error on your return? It happens. This is where a really important distinction comes into play, because the CRA looks at errors in 2 totally different ways.
It all comes down to your intent. On one side, you've got reasonable efforts. This is you making an honest mistake. Maybe you used approved software, you kept your receipts, you worked with them to fix it. The outcome? You'll probably just have to pay back the tax you owe plus some interest. But on the other side, you've got malicious actions. We're talking about intentionally hiding income, making up fake receipts, stuff like that. That's considered fraud, and it can lead to some really severe penalties. It's all about your integrity.
All right, let's wrap this up. We've covered a lot of ground, so let's boil it all down to the most important things you need to remember. So here it is, the bottom line. The CRA knows people aren't perfect. They know mistakes happen. The goal isn't to file a flawless return. The goal is to show that you made a reasonable, honest effort. The key isn't whether there's an error, it's whether you filed with due diligence and acted with integrity.
And that just leaves us with one final thought for you to take away. After hearing all this, from the self-checks to how the whole review process works, what's the one proactive step you're going to take to manage your tax risk this year? Just thinking about that now is the best way to set yourself up for success.